without any further ado, Sam Teden is our first speaker. We're going to have two speakers altogether. Sam is going to be first. Sam is investor in Anthos Capital. Anthos Capital is in United States, on West Coast, in California. It's pretty amazing. Their last fund is $1.5 billion. So this is a lot of money. Sam is one of the investors. And Sam, my first question to you is that if you look at your website, it's the most minimalistic I've ever seen. I don't think I've seen more minimalistic website. It's almost, I would say, secretive. I'm just burning to know, like, why, if you have actually over 2 million assets under management. And then please take it also from here with your introduction, and the floor is yours.
Absolutely. Thanks so much for having me. And I will apologize before I get to your question for doing this from my phone. Truly 10 minutes before this started, the power went out in my house. So talk about adversity and working through it. Here we are. So again, apologies for the kind of weird setup. But yeah, to the point about the black landing page of a website, it's something that we've always done. We believe in a couple things at Anthos and kind of representative through this kind of black landing page. One is that we're a support mechanism for company success, not the reason for company success. And I feel like where things have gone and the world of Twitter and social media, a lot of investors try to be pride themselves on Twitter followings and really promote are self-promoters rather than promoters of a lot of their businesses. So we like to be very much under the radar, really like to just be a kind of support team for our company's success. And at the end of the day, if we do that and our companies have successful outcomes, then that means our investors get their money back and some. And as long as we're doing that, we're keeping both of our kind of customers happy, our entrepreneurs and our LPs. So that's kind of the first part. The second part of it is that we don't like being promoters, but two, it's just for us, it's a lot more of if you look at a lot of the websites out there and take down the window dressing that everybody is kind of prettied up on their website, everybody says the same thing, right? We're founder friendly, we're doing a good job, and here are investments, and yeah, we just simply like to go kind of the road less traveled. But that's the black landing page of the website. Trust me, I've been here for 2 years, so try interviewing at a place where you have no idea who you just met, what they do, or the investments that are in the fund, other than the context that I was getting. So that was a fun hurdle to jump. But a little bit about me and Anthos to kind of kick it off. First, I'm based here in Charlotte, North Carolina. Our fund is actually based on the West Coast in Santa Monica, California. I joined a couple years ago. Before them, before Anthos, I was with a private equity firm that focused specifically on B2B software and doing majority growth recap type investments. And before that, I was actually in the insurance world in the United States. So no better place to start in the insurance world with the most screwed up healthcare system. So learned a lot there, made a transition to the investing side. And in Anthos, kind of as I look at us, we're a 14-year-old minority growth equity fund. We got our start back in 2007 when our two founders launched a $30 million fund, really on two core principles. One being we want to be high conviction investors, meaning we want to put more wood behind fewer arrows, which in turn leads us to kind of our second principle of being a servant investor. And what that means to us is really being an investor that has the capacity to do whatever our companies need us to, whether we have the internal capability or need to go out and find external resources. And due to the capacity that we've created of having fewer investments, we can then kind of sit in the trenches next to our entrepreneurs and teams and help them solve these problems. How that kind of looked in practice was Fund 1, $30 million. We only made 4 investments. They were broken out across fintech, healthcare, consumer brand, and a game company. So really kind of diversified approach. All 4 have did exceptionally well. It took us 6 years actually to invest that fund, so wasn't any sort of overnight success. And fast forwarding to today, we are now investing out of our 5th fund. It's a $1.5 billion fund that we raised in March. Still very much practice this kind of high conviction strategy, and really like to be opportunistic. Don't like to draw lines in the sand that would prevent us from getting a deal done. And really like, again, partnering with our entrepreneurs for a longer kind of time horizon. So we don't just invest in a Series A or a seed round. We'll invest from kind of a seed Series A all the way up to a later stage kind of $150 million check. So like to be opportunistic and still across consumer internet, consumer products, enterprise software. What I thought I'd kind of just hit on today is, again, I'm no like rocket scientist. I haven't been in this for so long to where I'm any sort of expert. Love learning from entrepreneurs and hearing their take, but thought I'd share just like a little bit of things of one, kind of how we operate internally at Anthos, what's made what I think is good investments for us and why they were successful, and then on the other side of the coin, why I think some kind of weren't so successful. And I think it all starts kind of at that investment, like pre-investment process of getting to know entrepreneurs, getting to kind of build that relationship, because at the end of the day, relationship and alignment really matters, and the ability to make sure that both team and investor are really on the same page. And a lot of that, especially for us being generalist investors, is making sure that we can really understand the business. And I think that starts a lot with entrepreneurs. We lean a lot on our team to be the subject matter experts. We get up to speed and understand the opportunity that they're going after, but really leaning on the teams to educate us. And the ones that can do that the best are typically the ones where our processes move extremely quickly. We can create alignment around the big vision, and then identify areas where we can be helpful. So for instance, I recently led an investment in a security business based in Canada. It's called Gradient MSP. So it's sold into managed service providers, it's mainly like a data company. But what drove us to the investment and kind of the initial problem set that they were going after was that the company kind of told us, hey, look, this is what's happening in the space. This is how we view the opportunity, and this is what customers kind of tell us. And therefore, we're productizing around that. This is a seed investment for us, so a little bit unique. But the kind of point of the story around Gradient was that we took 2 calls with MSPs that were not even customers of this technology that we were looking to invest in. And without saying a word about what their core kind of value prop was going to be, MSPs came out and told us, hey, this is the biggest problem that I have running my business. So all going back to kind of the storytelling, the understanding of the business model, and then the opportunity, this team kind of hit the nail on the head. So gave us a lot of conviction to come in, move quickly, and really back a team that clearly knows what they were talking about. And kind of also to that point, we also focus on a lot of businesses and like to see businesses that can really explain their business in a couple sentences. Hey, what do I do? What's the problem I'm going after? And what's the solution? Ones that we see as, I don't think that means that it's not a complicated problem or a hard problem to solve. It can be a very complicated problem, but the ability for teams to really dumb it down for investors who aren't spending all their time in this, certain domain, definitely helps get people on the same page quicker and create alignment around what the company is kind of achieving. The next one, and I kind of hit on this about understanding the market, and this is a very recent example. Yesterday, I was a judge in a competition in Charlotte for veteran-run businesses, and listened to 5 pitches. And the winner of the pitch competition was a company called ComSafe that, when they were explaining what their business was doing in the market that they were going after, they didn't just throw out this $515 billion market. They actually really honed in on saying, hey, here's my market, here's my opportunity today, and really kind of expanded out and enabled us to understand, hey, look, this isn't a multi-billion-dollar opportunity right now, but they absolutely know who their customers are and why they're going to be successful in that space, versus just saying, hey, I'm this solution in, we'll just take healthcare, and I'm going after a big problem. Like, that's great to know, but the ability to really understand why you're going after that, who your initial customers are, gave me and the other judges kind of a runaway winner in this competition. So a recent example there. Other things that really enjoy seeing as I'm getting to know entrepreneurs and we're getting to know businesses is, I think over the years, over 14 years of Anthos being around, like, not one of the companies, regardless how successful the end investment was, it never went up and to the right the entire time. There were always issues, always problems, and always areas where we like to see our companies like raising their hand and saying, hey, I need help here. I need help figuring this out. Or, hey, I'm not sure exactly why this is happening from a go-to-market strategy. It's been working perfectly for a year and a half, but it seems to be slowing down. Like, what is the problem? And as investors, we enjoy helping. We enjoy being a part of the ride. And when entrepreneurs can come to us and say, hey, look, this is the support that we're looking for from you. This is where I know my deficiency is. Then that is super helpful for us. And I just think a nugget that a lot of entrepreneurs probably don't understand of, wanting to be the perfect investment. There is no perfect investment. Everybody has, problems from running their businesses. So, like, be outright with it, of saying, hey, this is what I've tried, this is what hasn't worked, this is what's worked, and really create that kind of relationship with an investor to align around those issues. Because if you're just looking for dumb money, there's plenty of dumb money out there today. You read all the headlines about high valuations and high dollar amounts. I would encourage you to find people that can help solve the problems that you're actually having. And then kind of from like a presentation perspective, just again, kind of thinking through the process of which we kind of get to an investment. I personally lean on the presentations that are shorter rather than longer. So as you're able to present something in a concise manner, that I don't see from an investor seat as that being someone who's trying to like get through a presentation quicker. I actually see that as someone who understands their business better, where you can accurately kind of say in a 6, 8, 12 slide deck, hey, this is exactly what I'm going after and why, instead of really kind of filling presentations with a bunch of filler, because at the end of the day, you are competing with a lot of time constraints on investor sides, and your time constraint yourself. So I would really put some emphasis on like a shorter versus longer presentation. There will be an opportunity to present a longer presentation at a later date, but especially as you're getting to know investors, I wouldn't kind of kill yourself over putting a 50 slide deck together. And then as I think about a little bit of like the investment process that we're going through and what gets us interested, I definitely mentioned a little bit about like the presentation side and like what we see from companies, but being generalist, we invest across these consumer product companies, which could be everything from a coffee company to a yerba mate tea company to a cosmetic brand, or we invest in deep healthcare or enterprise software. So the models are different, but what we always look for and really think is important is like the intensity of use, right? As we can identify that people are utilizing a technology or product at a high rate, that is one of the more important metrics that at least I value, because that either demonstrates, hey, this is ingrained in someone's workflow, or someone like repeat purchase rate, like someone really likes this product and would be really pissed off if this product went under. So as you're able to demonstrate and be able to get this kind of addictiveness of use from product or technology, that's something that we look at. And then, team is definitely important. And again, understanding from a team perspective, especially at the earlier stage, your executive team isn't built out, right? You're wearing 100 hats, you're doing 100 different tasks a day. Understanding what exactly or where exactly you see your hiring plan going. We have thoughts on that, but I don't think that we expect anything to be solidified. So coming to us and saying, hey, this is why I'm the person to solve this problem. This is why the team that I've gotten to this point are the people to solve this problem is important, but don't feel like you need to act like you have all domain expert or expertise around the table. Leveraging third parties are super helpful to kind of get to that point as well. And then we can be helpful in kind of building that out. Kind of getting into a little bit of like, when I think back onto the portfolio and what has created a positive outcome for us versus a negative outcome. I think a couple things pop up on the positive side. And I hit on it earlier, one being around alignment, really creating alignment with the investor that you are kind of getting to know is super important. And in companies that we've been super successful in, I'll take Honey. Honey is a browser extension that automates coupons at time of checkout. We invested in this business in late 2016 and exited the business in early 2020. Sold it to PayPal for $4 billion. It went from like 25 million of revenue to 125 in a few years. But why this company was successful, I believe, is one, because I think an amazing product. They had created a lot of loyalty to it. But as they were evaluating investors, we were picked because one, we had our president who a lot of experience at Google, Facebook, Snapchat, Instagram, which was a very formidable relationship for them. And then, two, they were looking for help on really like cost of acquisition. And based on our previous experience, it worked. And we were coming in we were actually spending a day a week with them on site and spending time thinking through those strategies and what was working and what wasn't. There were some pivots going on as we were looking at trying out a lot of different marketing aspects. And there was also a good bit of enhancement from the team perspective. So I think from an alignment perspective, they realized, hey, Anthos has this kind of expertise that fits well with where we have a couple blind spots, even though they were a extremely high growth business when we got involved. So that's kind of one success story based off of alignment. And I think of a second kind of instance of what's been successful is really like the willingness to ask for help, the willingness to really like come in and be a true partner in kind of this growth exercise with these teams. So we had a company based in Scottsdale, Arizona. They were going from 5 million of revenue to 15 million of revenue. They had been incredibly successful. We invested $40 million in this company. And 6 months into the investment, they kind of like raise a red flag to us. They say, hey, look, we're starting to see a slowdown. We were expected to go to 15. We are now like really stuck at 12 and we're seeing somewhat of a leaky bucket. We're seeing churn happen. Can you help us kind of think through this? We spun up a team internally, went on site with them for a couple of days, worked through a lot of like what we were seeing from like what the data was telling us. And that enabled us to work through the problem quickly instead of, the team thinking, oh, I don't want to draw attention to my investor. I don't want them to be mad at me. Instead it was, hey, let's hit this head on. So those are kind of just like two areas. We ended up exiting that business for 500 million later that year, or the following year. But a couple ones that have failed, and I'll keep their names out of this, just due to respect to them. But we had a company that was in the healthcare space, was a brick and mortar healthcare business helping really like on the addiction side. And what the company was doing at the time of investment, they were growing really nicely. They had gone from, again, like, 3 million of revenue to 12 million of revenue, showing very positive signs, profitable in what they were doing. And what they weren't noticing is that there was a change of regulation going on, and therefore the entire landscape was changing. And the team's inability to kind of listen to what the market was telling them, thinking that, hey, like, this is not necessarily like the reason for our failure isn't because of us, it's because of an external force. They were more worried about just operating efficiently internally instead of really always keeping a view on like what the landscape looks like. We constantly see that over even a 3 to 5 year investment horizon, there's a lot of change that's happening. And the ability to kind of impact that from understanding that and being willing to accept that and kind of adapt. In the second aspect,
Sam, if it's okay, I would now also take a few questions, or maybe if you just wanted to finish with the example. No,
it's fine. I'm happy to take questions.
All right, so there's quite a few. I'm gonna take a question from Anthos about the team, and also it goes well with today's kind of main theme, is that like, what's the situation, or what's your take on, like, if in the middle of the due diligence it kind of feels that there's like some kind of relationship problem, or I would even use the word ice, as Anthos has put it, between the co-founders. What do you do then?
Yeah, that's definitely something that we've worked through before, where you kind of see one co-founder that either has one foot out the door or isn't as invested in the business than the other. It's a concern. I think that is something that can really like make an investment fall apart from the investor side. And I think it's something well worth kind of like bringing to the forefront as soon as it starts happening. Having said that, we've worked through it before, understanding that, hey, the one co-founder that might not have the alignment here actually isn't planning on being active in the business, and therefore like there could be an opportunity to actually like sunset that co-founder by giving them liquidity, buying them out, and kind of restructuring the team. We put a lot of weight on the team though, so where it's been successful to kind of like work through it before, it is definitely something where it's not necessarily the easiest opportunity to kind of work through.
Okay. I've never heard the term sunset somebody, but I guess I know what you mean. There's also a question from Mark. I guess you know Mark asked on this, but like, what is if you can pick, like, let's say one most common problem within the companies which you have invested in, what is it?
Thanks, Mark, for the hardest question. I'll be sure to email you after this and give you a hard time. I would say it's definitely talent. I mean, in a war for talent today, it's really hard to attract and retain the top talent. I mean, from everything, I think 50% of our companies are either looking for some powerful marketing, like head of marketing, or some powerful like head of sales, and they don't grow on trees. So we're really trying to kind of figure out how to best manage that, but not having the right team in place is detrimental to a company.
Okay, very cool. And last and very short question from Jin. Like, when you say short about the presentation, how many minutes do you recommend?
Yeah, like I think on initial conversations, I I think companies should be able to articulate what they do and how they do it and the market that they're playing in, in 20 minutes, 20 to 30 minutes, leaving kind of 15 minutes in a 45-minute meeting to create discussion. I think this is an initial meeting, right? I think as you continue to build the relationship, I mean, I kind of think of it as a funnel, right? Initial conversations with investors, you're going to have lots of them, right? To try to enhance the likelihood of getting a deal done, but you're still operating a business. So the last thing you want to do is go hold like hour and a half meetings with investors, where half of them are coming up empty. So I think like being able to articulate the business in 20, 25, maybe even like 30 minutes, and then leaving 15 minutes in a 45-minute meeting for questions, and kind of just general conversation, I think is a good way of doing it.
Okay, thank you, Sam, so much.